To achieve anything in life, most people would accept having to operate outside of their comfort zone to get what they want. The probability of failure is always a real possibility, certainly at the start. Learning through our failures is therefore part of how we progress in life. Those who embrace it stand a much better chance of achieving their goals than those that don't. What this means is that every time we make a decision where there is a chance of failure, it almost always involves having to take risks. Now, taking risks is just a part of being a human being. We all do it every single day. Each time we cross the road, for example, we're taking on the risk that we might not get to the other side. But that's a risk that we're prepared to take in order to get where we want to go. In fact, anything that we do where the outcome is not certain automatically means that we have to take on some degree of risk, be that large or small. So what becomes important is not the risk-taking itself, more our skill and ability at evaluating and managing those risks that we choose to engage with. It's highly possible that trading markets is one of the most uncertain environments that you'll ever encounter. So it shouldn't come as a surprise that every form of investment in the finance industry comes with a big warning sticker attached. Past performance is not a guarantee of future returns, complex instruments come with a high degree of risk, you should consider whether you can afford the risks involved in trading, and so on. These are the types of phrases you're probably already familiar with, usually as part of the small print at the bottom of a website. Fair warning then, the risks can be high, but then again, so can the rewards. Just because any activity carries a high level of risk, does that mean we should automatically avoid them? That's a difficult question to answer, but what we can do is make more effective decisions, and that starts by deepening our understanding on how to handle and manage risks. First up, what is risk? Well, it's actually pretty simple. Risk is the balance between positives and negatives. Think of it like a scale. If the number of positives outweighs the negatives, then that might be a risk worth taking. If the number of negatives outweighs the positives, then maybe not. We could essentially make every decision like that. It's certainly logical, but here's where it gets interesting, because the research behind how we evaluate risk says that when it comes to making a decision where risk is a factor, simply adding up a list of pros and cons is not enough. If it were, we'd all make the same choices, but we don't. We all see things differently, so risk is also a perception as well as a balance of outcomes. We naturally always gravitate towards the things that we like, so when we start to learn something new that involves uncertainty, our perception of risk reduces as our understanding and level of experience grows. This is what makes it possible for some people to scale cliff faces and climb mountains. Whilst the risks involved are immensely high, the change in perception of those risks allows the climber to embrace the danger, operate outside of their comfort zone, and achieve something that they've never done before. Most people believe that driving a car is much safer than riding a bike. However, statistically, that's not true. The risk of death from driving is much higher than the risk of death from cycling. Humans have a strong tendency to underestimate the dangers in high-risk activities, but also overestimate the dangers in low-risk activities. The point is, what we fear will destroy us and what will actually destroy us are usually completely different. In trading, this faulty logic in perception can cause real problems. New traders will often learn the basics and start to develop some confidence in their ability, but will then go on to wildly underestimate just how risky it can be. History is littered with famous examples of traders who lost sight of all of the risks involved. Jerome Carviel lost $6 billion whilst working at Societe Generale in 2007. Nick Leeson lost $1.3 billion in 1995, bankrupting Barings Bank. And in 2011, UBS trader Kweku Adeboli lost $2 billion trying to hide his losses. No question, these are extreme examples, but they serve as an important reminder to all aspiring traders. Whilst we can never change the inherent risks involved in trading, what we can do is learn to work alongside them. That is why the key to trading success is risk management. What we must do as traders is understand that our perception of risk changes as our knowledge and skill grows, but the risks will always remain the same. It's then our job to learn how to best manage our accounts so that we can capitalize on the opportunities the market offers whilst managing the high degree of risk involved. There is an old trading adage: it isn't the money that you make, it's the money that you don't lose. This taps deep into the heart of the problem. If you can limit the negative effects that risk might have on your money, you stand a chance of benefiting from the profits that you make by keeping hold of them. Thankfully, there are several tools and techniques that we can use to manage our risk in the market. The more you understand how they work, the better your management of risk will be, and the higher your chances of long-term trading success will become.